What's up, everybody? Welcome to another show from 21st Capital. We have Z from Glassnode again today. Today is Saturday, November 30th. Bitcoin's price is at 96, slightly above 96. We have corrected from almost 100. We actually almost touched 99 point something, depending on the exchange you look at. So we did try breaking the 100, but the sell side was very strong, which was absolutely expected. If you look at the price, we almost, depending on the exchange, we went really close to breaking 100. Then a couple more tries, and then a decisive bounce back. So almost a $10,000 correction, and this actually worked out very well for me. I was selling call options here, and also selling put options at the bottom. Both worked out well, so the price actually couldn't reach too further below and too much higher. But now we are back, slowly creeping back up towards another assault on 100, and just correcting a little bit in the last 24 hours. So today we're going to talk about the on-chain indicators, what might impact the future trajectory of Bitcoin, when 100K might break, and how are short-term and long-term holders behaving. Plus, we will look at the options market. Z has some amazing content on that. So welcome, Z. It's known as Crypto Wizard, or Z.
Yeah, I was mute always. I just missed that little button. Hello, Sina, how you doing?
Very good, very good. Looking at the market, it's a nice weekend, and Bitcoin seems to be getting itself ready for some interesting moves.
Yes. Oh, let's jump into it right away.
Okay, so I have a couple things to discuss, and then we can move on to on-chain data.
Sure.
So let's see. Let's get ourselves smaller. Okay, so we look at the price here, and then I have some longer-term models to discuss. If you've looked at our power law indicator, this is a general sense of what the average price might be in cycle according to the trend. Essentially, the white line is our trend line. Just last week, I think it was at 81K. Now it has moved up another $1,000. And while the price is, moving, playing around right below 1K, this fair value metric is also catching up. So that's good. But also this tells me, like, if you measure the distance from the fair value, again, by fair value, I just mean the average price according to the trend, then you get to this one, the VPLI index, which actually shows we are very neutral. We aren't really much above the expected trend. If you look at this trend line, that goes through the middle of the data points. We are kind of back to the middle. It's far from any crazy deviation to the upside. And we are essentially at the fair value, I would say, and neutral valuation, as I have listed here. So really good place. It's no danger of a bubble or something unexpected. If you actually want to quantify this, we can also look at a quantile model that puts us at 97 percentile at 66 quantile. So if you look at here, breaking down the historical price range into three probability groups, 1/3 each. We are kind of 2/3 up from the bottom of the bear market in today's potential distribution. Again, the way we think about this here is we assume there is a distribution of possible prices for today, and we are 2/3 of the way up, but this is highly skewed because it's on a log scale. So the rest of it is actually a lot more than the first 2/3. So, and if you look at historical pattern, we typically bounce around this level. I don't know why, but it's very interesting that before moving into the FOMO phase, we don't suddenly get into it. We kind of bounce around it and then suddenly do the actual move up. And that's exactly what we're doing here, because if you look closer, we are kind of stuck right on that boundary. And if you look even closer, you see we've had a bunch of reactions up and down. And these lines are not optimized for this. These were drawn a long time ago. And for some reason, price just wants to, we're stuck right at the boundary. Now, if historical pattern continues, as you can see, once we decisively get into the red zone, this is where the FOMO begins. Rapid rise, stronger corrections, a lot of FOMO, a lot of corrections, and then at some point we probably would correct and come back towards the larger, longer-term growth line, which is this one. So again, all this is dependent on historical pattern. So be like in your mind, have like 20% chance that everything could change. You know, all the cycle patterns could change, and it's good to be open-minded. Now, another thing I'll say is, so this is where we are in general. Kind of neutral valuation, slightly above our fair value. Very good place for Bitcoin to easily break 100K. It's not really leverage driven where we are, so it's kind of right at the fair valuation. Now, another thing we could look at is the on-chain data, especially to see if you want to understand how likely we are to move past 100K. It's good to, based on, if you've listened to our previous discussion with Wizard, he has explained that looking at short-term holder behavior helps us a lot in understanding the short-term movements of the market. Well, long-term, pretty much everyone knows that it's up, but short-term is what creates the most anxiety and surprise. So here I'm looking at net unrealized profit and loss of short-term holders. This is basically a measure of how much profit short-term holders are sitting on. If you're sitting on a lot of profits, there's a risk, right? But that doesn't necessarily mean we will correct. It's just amount of possible sell pressure. It's kind of the potential. And then when we look at it, it's actually interesting because in Q1 2024, this metric, the orange line, went as high as 0.3. And it actually got into the yellow zone on this chart. And this indicate overheated, or in other words, too much profit in the hands of short-term holders. Short-term holders are likely to trade more than long-term holders. So, and then they began selling. Now, what happened in the first try to 100K, we reached a similar level. So this meant that a lot of people were in significant amount of profit. So it created the condition for a sell-off. But another thing interesting, maybe I get Z's idea. This chart, the tops of this chart are decaying over time. So it's likely that in the next few years, we won't actually go as high as we went in the previous cycles. What do you make of this, Z? So like the top, like in one of the earlier times, we actually went as high as 0.57. In the next one, we went as high as 0.44. Next cycle, 0.38. And then after ETF approval, what was it? 0.3, I guess, if I move my mouse right, or 0.26 or something.
Yeah.
What's going on here? Can we assume that this top is actually decaying over time and next one is going to be slightly lower even?
Yep. Well, you explained it perfectly well. This is looking at the net profit, I mean, profit minus loss of the short-term holder. And by short-term holder, we're talking about the investors who moved their coin or purchased their coin in the last 6 months. The reason you're seeing a decay in the top, or I mean the peaks, it's because the volatility, specifically the 6-month volatility, realized volatility, is decaying. So those beautiful green tops that you can see at early 2018, it was because the market was so volatile. Even if you look at the 6-month realized volatility, it was higher than, by average, it was higher than the recent, I mean, cycles. So you could see their profitability, or Newpol, is a function of how volatile price is upwards. As you can see, that volatility is damping for different reasons, maturation, I mean, derivatives are gaining a lot of traction. All these factors cause this volatility to actually drop and drop. I mean, even if a 6-month or a yearly volatility, and that is affecting many on-chain metrics. So that's actually a good point. When we look at these metrics, especially the short-term holder, we have to look at the statistical band, and we have to use a rolling window. What do we mean? When we want to define the up and low bands, we have to look at the recent data. We should not look at the cumulative history and make a decision about what is too high, what is too low. And that Newpol is an example.
Exactly. Awesome.
Yeah.
So interesting to know. Maybe there must be some kind of volatility adjustment here as well.
Definitely,
Sounds like
especially
yeah.
We have to adjust it with 6-month volatility, realized volatility, or I mean, it would be really interesting to use implied volatility. But I mean, I don't want to get to the math, but yes, volatility adjustment for metrics like this one makes a lot of sense.
Oh, actually, maybe you can get the options market's implied volatility to adjust these. Maybe that would be an interesting.
Definitely. I mean, if you look at the implied versus Newpol, you are literally speculate. At least if you want to, I mean, monetize volatility, as many of audiences might know, options market also gives you the opportunity to make money out of volatility. This, if you put this next to an implied volatility deviation from realized, you will get a really nice dashboard to spot high potential for volatility in the market. I don't want to get to the math, but yes, definitely lots of work there.
But the good thing in here is we have corrected quite a bit after the sell-off, and then we are almost back, but from a better position. So fewer people are in profit right now. So that's interesting. And then learning from you, I've also looked at the SOPR metric. And this is, again, short-term holders, and it's showing spent output profit ratio. Very complicated name, but the concept is very simple. Essentially, how much profit actually is getting realized or lost.
Yep.
So remember, last time we said this is unrealized gains, but this one actually is realized gains. So the beauty of this combination is that one of them gives us how much potential sell pressure exists. The other one tells us how much actual sell is happening. Then again, if you look at it, so if you actually were looking at these charts, you would have been able to guess what's going to happen at 100K, because a lot of people were realizing profits, and this was actually at a very high level. It's 1.09. Above 1 means people are realizing positive profits. And this is like historically high, very high, like matching the two tops of the ETF craze, top of the ETF era, if that's the right way to say, Q1 of this year, I mean. Now, the beauty of this is now it's done. It's almost gone. And exactly at the top, you could have guessed, exactly at the bottom of the recent correction. If you did look at this chart, you could have guessed that we're going to bounce back up. So, we are now at 96, almost 97, and this metric has reverted. So it's kind of cooled down a lot. So preparing conditions for a better move from here. What do you think about this one, Z?
So far is really, like you said, is just beautiful. Actually, if you put it next to funding rate, it is giving you this, not the same value, but I mean, the ups and downs are matching really nice, especially when there's a volatility in the market. That tells you, like, because when you look at the option market or derivatives or on-chain data, you're doing a survey. You're looking at a portion of the investors and see what is the incentive. The way you explain it actually makes sense when you look at the funding rate as well. When you've seen a huge spike, I mean, it was 22nd of November, I believe, huge spike in SOPR, the chance of at least short-term or mid-term correction or sideways is really high because it's a top blow off, even if it's a local one. The question would be, okay, when we had a cool down, when the price, I mean, not the closing price, but I mean the hourly price dropped by 10,000 almost. And as you can see, so far reached to the one level, or I mean neutral value, and then bounce back. That is telling us the short-term holder who were realizing loss or probably less profit, they stopped selling because the price got close to their cost basis. Not exactly their cost basis, but got closer to cost basis. And the next question would be, do we break below one? If you go back in March or April, we were touching the neutral value a couple of times, meaning the market was showing weakness to break above 74. Then we entered a midterm phase of SOPR by average below one. So the question right now is a decision, it's a decisive point when the SOPR drops below or close to one. If market wants to continue the bull run, this is the point. But if we show the weakness, if we continue sideways, the chance of entering a midterm to long-term bear market is getting higher and higher. So if Mr. Satoshi or market or OGs or Michael Saylor is trying to push the market up, I'm just trying to be funny, but I don't mean they are actually the driver of the market. But I mean, this is the moment that everyone that are expecting the market to bounce back, this is the moment. If we just drag longer, the chance of entering a midterm to long-term bearish phase is getting higher and higher.
But see how great this metric is. Like right at the top of the ETF craze, this was just flashing huge warning signs. And then almost at the bottom of the correction, after many months, it was here. And price was at 54, and the metric was flashing high likelihood of reversal. I think we actually did go a little bit below that at 53.9 later, but this essentially, if you had entered the market here, this would have been the best place.
Yep.
So pretty interesting that these things are not priced in. Like, I guess not people aren't aware of the power of on-chain data. And then, like you said, I really like this point because you also need to look at the recent averages, because the market can get into a regime of negative below one SOPR.
Yep.
Or right now we are in a regime of above one, and whenever we hit one, we bounce back up. But we actually, if we hit it, we go back, we go below and stay there, then that's gonna actually kickstart a reversal, I think. So now, but I wanted to ask, do you prefer any sort of moving averages on this chart, because it's very kind of
14.
up and down?
14 EMA is really nice.
So let's do that. Yeah, so it shows us when we go below on this, it's really showing the local bottoms. Then we go up and get a local top, get a local bottom, local top, local bottom. This is amazing. And then we just had our local top, and we're coming back down. So people are now realizing less profits. But the 14-day actually might...
this is for a long term. That's like
longer term.
Imagine, so if you can make it like EMA 7, or I mean on a, let's say 5 days, that's more decisive for immediate term. But if you're going to go 14 or monthly, that will give you like a some tool to speculate about the midterm. Like, okay, we're going to enter a couple of months, weak chop solidation, like Czech put it, or some bearish phase in the market. So you have to play with this and use a statistical method and adjust your rolling window based on recent data. So it is a good raw metric, but I beg everyone to not just look at this chart and say, okay, SOPR is at 1, we're going to bounce back. This is a strong metric, but always you have to use it I mean, in confluence with the funding rates and all
Yeah.
different metrics that you have your hands on.
I remember Czech was talking about like us breaking below, and it was funny because it's a great way to think about it. For example, here once we broke below it, then we actually stayed below. But it's funny that after the ETF local top, we were kind of breaking up and down, up and down, up and down. So it was like
Yeah.
the one line. This line was actually getting violated quite a bit. Very interesting, but I think you can learn two things. First, the bounces from point one are interesting, plus the maximum and minimums,
Yep.
the extreme deviations.
Yeah. And in bear market, it's just on a long-term moving average drops below one, and it's going to hit one and get rejected by one, because every time price, like go back to like 2018, 2019, for example, in a long bear market, you could see the regime moves below one, and so far hits the neutral value and then drop, because the short-term holder who gets at a little bit profit or at their cost basis, they want to jump out of the train and just save their money. See, so it's really beautiful. By long-term moving average, you can define the regime. By very short-term moving average or EMA, you can actually locate local tops and bottom in bear and
for example,
bull
here after we hit the first top in last cycle, we just crashed below the one line, and then every time we bounce back up, we actually got rejected from one a couple times.
Yeah. Very
okay,
strong,
very cool.
very strong metric. Yeah.
So let's move on to what you have for us today. If you want to
Sure.
share, I have your screen. I can share that.
Sure.
Let me remove our images. All right. A bunch of colorful stuff.
Yep. So I'm going to go back to what we put out, and everyone can go back and look at the article. It was called Assessing Risk in Bull Market in Glassnode, insiderglass.com, if you want to know what is the meaning of these charts and have better understanding. But I try to go over 3 or 4 of them to just talk about where we're going. So we're going to do some sort of cycle navigation. Where are we? The first one, and my favorite one, is a combination of MVRV and Mayer multiple. For audiences who are hearing these terms for first time, I have to say MVRV is looking at the ratio of the current price, spot price, to the cost basis of the market. Higher MVRV means we have more unrealized profit in the market, and lower means we have less unrealized profit. Mayer multiple is looking at the price ratio to the 200-day moving average. So it's some sort of like replica of the MVRV, but more technical. It's just rooted back to the technical analysis, but MVRV is more on-chain. By tracking both of them and locate the zones that, for example, MVRV is 2 standard deviation from its mean, and MVRV itself is 1 above 1, which means like we have, by average, we have a lot of profit in the market. When these two are having a good confluence, we have high risk zone, like for example what we had in 74,000, or what we have I think it was 40 something, and then 69,000 back in 2021. All these structures were based on this metric, were signaling, okay, we are having too much unrealized profit. Comparing the recent break to almost 99,000, it is really interesting. The price is higher than 74, but speaking of MVRV and Mayer multiple, it shows, yes, the unrealized profit is comparable with what we had. I mean, in terms of ratio, we are pretty at the same level of unrealized profit that we were in back in March. But in terms of Mayer multiple, which is a ratio between current price and the 200-day moving average, we are not as risky as what we were back into March 2024. So this is the first one. So based on the unrealized profit, we are in the zone that we call it a little bit risky, but in terms of technical analysis or using the technical moving average, we are not as high risky as what we were in back in March. The same time, we can, because this one is looking at the size of the profit, how the magnitude of the profit across the market. But if we want to look at the binary from a binary
Z, one
perspective,
question. Any way you can
sure,
make these larger? Because it could be
sure.
difficult to read.
Okay, what about this one?
Yeah,
Is it good
perfect.
now?
Awesome.
Nice one. So if we look at this metric, so that one gave us a sense about, I mean, the MVRV and Mayer multiple gave us a sense of about the intensity of profitability. Let's say I want to make this example to just make it, I mean, teach people. That's my favorite thing to do. Imagine we are measuring the number of people who are tall in 2 different countries. Okay, this metric is looking at the supply in profit, percentage of supply in profit. So going back to that example that I just made, let's say whoever is above 150 centimeters is called tall. This metric is showing what is the percentage of tall people in country A and country B. But the previous chart, which was MVRV, it shows how tall they are. If 2 countries have like 50% tall people, 50% not tall people, but one of them are 40 centimeter above the average, one of them 20 centimeter above average, the intensity of the first country is higher. Right now, in terms of the percentage of supply and profit, we are very close to, they call it all-time discovery. That means like more than 90% of coins are a profit. In terms of a binary perspective, we are actually are going through a very high risk zone, like 74,000 in 2024 or October 2021 or March 2021. So in terms of how many people, how many coins are in profit, I mean, share of them, we are at high risk. But in terms of how profitable they are, we are not as profitable. I mean, in terms of intensity, what we were in March or what we were in 2021. I mean, again, March 2021. We are very close to what we had the second top. I'm not saying this is the second top, but I mean, in terms of intensity of profitability, we are living there. Back to your point, when you were saying the short-term holder were actually showing some sign of, I mean, dropping their sell pressure. This metric is showing their, I mean, it's another way to look at Newpol, but is look at the ratio between profit and loss instead of looking at the net value, the difference between them. As soon as we broke to 90,000, the ratio of the, I mean, let's say there's 2 million coins owned by the long-term holder, the short-term holder, the recent buyers. You could see when we broke through 90,000, the ratio between the coins by short-term owned by short-term holder to the loss was dropping and dropping. That is a really good indicator. It's a replica of what Newpol does, but instead of looking at the difference, look at the ratio. This is really, really better
So
alternative.
when you look at ratio, what are the good thresholds to follow?
It is in a log. It is a log ratio, but I mean 10, which means more than 90% are in loss and 10% is in profit. So the ratio is 1 to, I mean, when you look at it, is dropping and dropping when the price start to drop.
Oh, okay. So this is this supposed to be between, but it's moving above 100.
Yeah,
so,
it's because you have to use log on it.
Oh,
when it's 100, that means like the ratio of profit is almost 99.99%. I mean, of supply is profit. 0.1% is loss. It's absolute profit. But when you drop it, like number 1, like this orange line, means 50-50. Profit and loss is equal. The ratio between profit and loss.
Quantity. This is amount of profit or loss or number of people.
It's supply. It's the supply.
Okay.
So it is the supply owned by people, but I mean, because it's short-term holder and it's very close to the addresses as well, but this is supply. So bottom line is 99 and then dropping to 98 or sorry 90. It was a textbook definition of a top blow off, local top blow off. It is totally normal. It is really natural. And as you showed, the SOPAR as well showed, okay, we saw the short-term holder stop selling as by price getting closer to their cost basis. So it is an ideal textbook of a local correction and then go up. This be the best definition. But like always, we're trying to show both bull and bear, even though the bull makes sense right now. I'll get to the bear case as well as we go on, if you don't have any question.
No,
Do
just
you have any?
very good.
Okay.
Just let's go back to the bigger views of the charts.
Sure. I'm gonna open. So we talked about the long term. I mean, the market in general. Now, as you said, so far we talked about the incentive, like how much profits they have, how much unrealized they are. Now let's get into the how much they are realizing in. I mean, in terms of like reaction to the unrealized profit they had. As you can see, when we got close to 99,000. The ratio
First,
between
what metric is this?
This one is the ratio of coins moving in profit to the number of coins moving in loss. And moving, I mean realized. So this is a implication. What implied behavior after people getting into profit. And this is for the whole market. It's not short term or long term. As you can see, hitting the MVRV above 1 or a Mayer multiple above 2 standard deviation, or in general, having more than 90% supply and profit is causing the investor to start to spend. When you look at the ratio between profit and loss, they're realizing it is really comparable with what we had back in March. Or if I just go back a little bit, it's almost higher than what we had in early 2021. So what is it saying? It's saying, yes, if the price is a good price for some investors, they're going to be sellers. That is contradicting the over bullish tweets you see on Twitter. Oh, we're going to go, we're going to 110. Yeah, we might go 110.
Yeah, and then people are like, at some point we're gonna run out of coin. Nobody's selling. But I've been just fighting some folks on Twitter trying to explain, hey, everyone sells at a price. As price goes up, new supply comes online. So we will never run out of supply. It's only that price goes high enough to bring those sellers in.
Definitely, like folks are buying Bitcoin since 2013. Imagine they bought it at 200, 500. Why not selling at 90,000? And it's close to 100,000. It's a very, very significant psychological resistance for a long time. So yes, expect people to start to spend. And as you can see, on-chain cannot lie. They were spending, and relatively speaking, slightly higher than what they were spending in March, or slightly higher than what they were spending in early 2021. But as you can see, that drop to 98 didn't cause a big decline in the realized profit to loss. What does that mean? That means even though we had a little bit correction, the momentum of profitability, the momentum of demand, or the buyers who jump in to buy Bitcoin, if everyone were scared, no one would have bought, right? So you could see that flow, that profitability is still coming in. That is a good sign for potential sustainability of this momentum, positive momentum and profitability. As you can see, when this metric drops drastically, like you see these big sharp drops, that means there are not enough buyers. There are not enough demand in the market to let this momentum be sustainable. But as you can see, the recent drop didn't put too much damage or didn't hurt this metric a lot. So I put this in the bucket of the bulls. You could see the momentum is still there, and as you can see, it is not seeing sharp drop from what we saw in March. But we have to closely monitor this. I'm not saying, okay, hey guys, we're gonna go 110. I said so far it's been positive. I encourage everyone just find these metrics and try to monitor it. I'm just showing the power of the on-chain metric, and just these metrics are really dynamic. You have to follow up. But yes, the textbook says we had a potential, and it was very well expected. I'm not saying we could have say 100% certainty, but it was very expected. It was not a surprise that we had a local correction, and still we have the momentum to keep continue, but we have to monitor these metrics. Yeah. And last thing I want to talk about on-chain, then I want to just don't take much time and jump into options, because they're really significant, and I really like to talk about it and have your opinion on it. The other thing I would like to say, because there was a big debate on Twitter about, okay, if they're long-term holder, what they're spending, like, because they were saying, okay, the top at 99. After November 22nd here, you could see the long term. This, let me open it. I keep forgetting that I have to zoom in. This metric, for example, is showing, let me show. The blue line here is showing the supply owned by long-term holder. And by long-term holder, I'm talking about anyone who purchased his or her coin in 6 months or before then. And you could see when we were getting close, very, very well before what hitting 74, they were spending, their supply is declining. And then again, as soon as we were breaking above 65, 70, they were spending again. You could see their spending, and the bar chart here is showing the rate of spending. He actually hit a very high number, similar to what we had in March. So you might ask, like, okay, they were spending, and if they're a long-term holder, why they're spending? There's, the long-term holder, especially if we call them 6 months, and I don't want to get to the details, but we showed among long-term holder, the one that were holding 6 months to 12 months ago. I mean, it's very, very young long-term holder. They were the main spender. And the people were asking why you call 6 months to 12 months a long-term holder. They're not really long-term holder. It's just 6 months ago. The definition of long-term holder comes from their potential or sensitivity to price when they were they're spending to the price. So the people who hold above 6 months their coin, they hold their coins for 6 months and more, they become less and less sensitive to price. But if the price give them the opportunity, they're going to start to spend. If they were not given the opportunity, those 6 months to 12 months would have hold longer and longer and wait for the price to give them the chance to spend. Well, it turns out market gave them a chance. The people who bought between 55 to 70,000, they got the chance now, and they're started spending. If the opportunity was not given, they would have become plus 12-month holder. And that doesn't contradict the fact that they are a long-term holder. As soon as, I mean, statistically shown up, the long-term holder who are spending are mostly spending on profit, and this plus $90,000 was one of those profitable moments, and they just seized it and started to spend.
So if profits are high enough, they're gonna trim the positions a little bit, right?
Exactly.
This might be just a small portion of what they hold or whatever, but they just have so much coins, so many coins that they might be incentivized to sell. This is the reason we cannot hit $1 million by next month or even next year, because when price, it might be that like price begins rising rapidly. Let's say we begin actually in the direction of 1 million, and then by the time we hit 200K, there would be a lot of short-term holder sellers and long-term holder sellers that would prevent us from going to crazy numbers. So there has to be a slow, gradual increase. And I'm sorry for the super bulls, but crazy numbers cannot sustain themselves just because as price goes up, sellers will show up.
Yeah. And last episode we had, it was 2 weeks ago, price was around 92, and the title was like, okay, room to grow. We were talking about, okay, there's still room to go up. And after then we were, I think we bounced back to 98 or 99. I'm not sure what's the hourly price. So these things can change really fast. See, the expectation, the reaction of market to what's happening, in the macro or whatever is just affecting the market, these are changing real fast. We have to be vigilant and look at these all metrics all the time. And the beautiful thing, I'll call it beautiful because I'm a bull. When we look at all these metrics we show, there was like an implication that we are in a high risk phase of the market, obviously, from long-term holder perspective, MVRV, everything. But in terms of intensity, we have not met what we were experiencing back in 2021 or 2018. And this chart is showing the profitability, the same concept of Nupal, but only for the long-term holder. This is MVRV for long-term holder. As you could see, they were spending as soon as we break above 3.5. That means they were sitting on 250% and above. And that, I think early November, when price break above 90,000, that was another instance of this structure. They were just reacting to profitability. But as you can see, these phases back in 2021 or 2017 lasted for a couple of months. This cycle, we were experiencing the same structure, but not in a sustainable way. That is the difference. You could see these red zones, which is high risk, is becoming shorter and shorter and more frequent. That is something that we can expand on and study, probably, me and you. That is implying the long-term holder cycle. The long-term holder economical cycle in Bitcoin is not following the 4-year anymore. It could be the last cycle we see the 4-year time difference between blew off and long-time profitability, long-term phase of profitability. Right now we're getting shorter one but more frequent if this pattern repeats itself again and again.
Very interesting.
Yeah, because before you start to comment on this one, we have different definition of cycle. People, traditionally and understandably, they call a cycle from the point that we had an all-time high, and then when we break above that long-term high, the previous all-time high, they say, okay, a new cycle is started, which makes sense. But it could be over time we get to the point that we do not correct a lot. 90%, 80%. And as we're going to talk about option market, probably these tools introduced to the market is going to help with reducing the realized profit, volatility. The implication or ramification of this is going to be we're going to have shorter time or even longer than 4 years. We don't know. What I'm trying to say is that 4-year cycle probably won't be the case from now on. Maybe one more cycle we see that 4-year one, but if that happens, it means people are still stuck to that mentality, and this is human repeating itself. But structurally, we are experiencing, for example, in this cycle, almost 2 significant all-time high in less than a year. It's just crazy.
Yeah, the fundamental reason for cycles have been two things. One is the halving that caused sell pressure to go down, and then the halving effect accumulates day after day, less selling, and at some point price begins moving, and that move actually brings in the FOMO. But we are actually seeing that in the last couple of years, the institutions are coming in, and their buys are much more than the effect of miners. Like ETFs can quickly buy a lot more than what miners could sell, or Michael Saylor, or many other institutions. So right now, the miner effect is probably very weak compared to other institutional players. And so the fundamental reason goes away. I think the only thing that could potentially cause us to see some of the cycles is the psychology, because at some point people just expect like next year is supposed to be the top of our cycle, and a lot of people expected just that expectation, even if there isn't much fundamental issues happening, can raise the price. However, we actually do have a ton of fundamental things that are happening next year. New administration is taking over. All our Bitcoin supporters, there's Bitcoin strategic reserve bill that's being presented. There might be some other companies following Michael Saylor's playbook. Meta Planet is doing that. Similar Scientific is doing that. And we are just hearing a lot of rumors about other corporate boards thinking about it. I think Michael Saylor was giving a presentation to Microsoft board. Just the fact that this happens is pretty interesting. And there might be a lot more that we still hear. We will hear about, but it's just stuff that are happening under the surface. So, but something like an ETF approval in the beginning of the year completely changed the pattern, right? We weren't supposed to have an all-time high before the halving, right? So it's very, very possible. Now, I want to caution people, do not think that the past cycles will repeat themselves. They can, but there is a really good case that things might change moving forward as well. So just have an open mind for that.
Definitely. Amen to that. Like, especially if people that the people who are looking at exactly meeting the same threshold value, the same level of, I don't know, that metric, X metric, Y metric, linearly thinking is what's going to kill you. I would say, like, that's why everyone's saying stay humble and start to stack, because the amount of knowledge, teamwork, and cost of being on top of all these things is crazy. And people who are studying these things are adjusting their threshold value. They're using a statistical method. They're using huge models to be able to actually outperform the DCA of Bitcoin. I don't want to get into that, but just to talk about what's happening in general, because I think in next episodes and episode after, I really like to talk about events. As you can see, the institution are coming and their behavior are, like I said, like ETFs, for example, are having net flow of 8 to 30 times sometimes what miners are potentially selling. So we should study their behavior more and more. On-chain is a great tool, but also options market are becoming more and more important. And I have to just say in disclaimer, by saying option is important, I'm not encouraging anyone to do trading option, because it is so complicated. But all these on-chain metrics or spot market and these metrics are talking about what's happening now. Options market is talking about expectation. What is the expectation of the option traders? And it could range from speculators, and thanks to the IBIT and all these spot ETFs option starting early November, now the institutions have the tool to be speculative or hedging in the option market. And this is really huge. I don't want to say huge because I mean, and imply that we're going to go 120 tomorrow. No. I mean, it's huge because identity, the behavior of players are changing drastically thanks to all these second and third layer of financial vehicles added to the Bitcoin ecosystem. What do you think, Sina?
Yeah. I mean, it's amazing. The more tools we have, the more attractive the market is for institutions. Like the fact that we have options on ETFs very easily tradable. Like previously, trading options on Deribit or FTX or other ones was horrible. Like big gaps between the big spreads between the ask and bid. Also, the whole platform could be rugged and um, not so secure, not so backed. Here you have regulated markets where you can confidently trade. And this gives institutions safety, right? And then once you can, for example, insure, a put option is like insurance on your position. Once you can easily and with very low cost insure your holdings, and you are confident that there's going to be a lot of a lot of liquidity when you want to get out of the position. This gives you a lot of confidence to go long, and this is part of the natural progression of Bitcoin to become a more mature market, a more palatable market for investors. And for example, one of the effects of these options are that when you feel there's a lot of risk, you don't have to sell. Instead, you can buy a put option to insure your position. And that is just going to have a dampening effect on the volatility further and further. This is why, as markets get more mature, as markets get bigger, as you get more variety and diversity of financial participants, volatility goes down. And this is all great.
Yes,
Exactly.
and
Yeah.
yeah, I
So
mean,
less cyclical and more steady. Yep.
exactly. And I want to start with this beautiful tweet that I think it was tweeted at the same day that IBIT or BlackRock started work. It showed at first hour of trading, 73,000 option contract was open. I mean, that first hour. And that put
This
the
is
IBIT among
November. This
19th
is a few days ago.
November.
Yeah.
Yeah,
Like 11 days ago. Yeah.
3 days before. I think it was 3 days before we hitting 99.
Hmm.
So that first hour of, I mean, opening 73,000 option contract put IBIT among top 20 active non-index options. Like, that is crazy. The day one, and I think I don't know when was it. It was I think week after, or I mean the first day. I think 1.9 billion notional value of the contract. I mean, the open interest in the IBIT alone, and that is crazy. In the first day, like you said, all these, and I have to add, after I think the Grayscale, ARC, and Fidelity, and Bitwise, all of them filed and they start to have their ticker. I mean, for option traders. The implication is, yes, it is bullish, but I don't want to push this naive mentality. That means that bullishness is we're going to go 120. I mean, next week. No, it is bullish in terms of the institution. Like you said, many of them didn't have access to their bit, and if they want to use collateral, because these big institutes have a big portfolio, they can use this portfolio as a collateral and stuff.
Exactly. Because
Go,
if you have a huge portion, that's
yeah,
a massive thing. If you have a huge investment elsewhere, like in Tesla or in Nvidia or somewhere else, you can now leverage that and get margin and then trade Bitcoin with it. So just the ability to have it within the traditional market brings in a ton of other investors.
exactly. So the first implication that we can say with a good certainty is the ability of the institutions to be able to, I mean, get into the Bitcoin market, and that's going to bring liquidity. That's going to cause less volatility and probably damped market moves mostly towards the downside because they're going to hedge their position. That is the first implication, and I think Sina, you agree with that. The second implication is I don't have the knowledge about how exactly they're doing it, but market makers, in order to be able to provide liquidity, I mean, in the option market right now, they have these tickers, and that would cause gamma squeeze. I don't want to get into detail what does that mean, but for example, if the price is going up and we're getting closer to the strike prices of the out of money call options, the market makers have to buy in the spot, for example, and that would amplify big moves upwards. The same story is about the downwards, but I'm talking about this ability that the market makers are having now to be able to cover their put and call that they're selling on the market. That is affecting the spot market as well. And in this case, in the short term, it could be like right now we're close to top. We will get to the contracts. We will see the density of the call options for the the late December and early January. It shows the potential of have a big move based on, the assumption that the market maker have to buy in a spot to cover the calls that have been sold for those prices. It gives us the incentive that there is a chance that we see have a gamma squeeze towards upward. So these complex strategies are probably a little bit hard to digest for ordinary people like me, but the ramification, the result is these institutions are in here and they're going to have some capital buy these vehicles introduced to the market. So long
Let me
term,
give you a third. Let me give you a third factor.
sure,
When you sell somebody a call option, essentially you're giving them the option to buy Bitcoin at a later date, right?
yeah,
To back that position, you should have that same amount of Bitcoin set aside. So the market maker will have to buy some additional Bitcoin and then write the call option against it. So this actually adds some buy pressure to the market. Same thing happens for a put option. The person who's selling a put option also has to think about um, some resources to put aside for backing that position. So for the amount of liquidity that will be attracted to the options market, some of that will also translate into a buy pressure to the spot. Not all of it, but it's not like this is all 100% paper Bitcoin and then there's going to be no effect on spot. Actually, a lot of that paper must be backed by real Bitcoin. So that's the positive side.
exactly. Definitely, there's a ratio, and I was looking at, because, like I said, I'm just very, very early at learning all these metrics. What does they mean? I was looking at the derivatives because still their OI is really high. I think their OI, the 7-day moving average, hit almost $34 billion. That's just derivative, their option market, and the daily volume at November 14 is hit $4.1 billion per day, and that's 7-day moving average. So you could see when we were breaking above 80,000, 90,000, the OI was jumping and the put to call ratio was jumping as well. I'm not too naive to say, okay, they were all hedging. It could be 10 different scenarios, but generally, if you look at it, then it's showing that the put to call ratio was rising, and as I mean, logically, you could see they were hedging, more hedging, and hedging was happening as we break above 80,000. That's derivatives only. So that's crypto native traders. And when you look at different strike, let me open. I should have opened these two. Was this clear, Sina? Let me open these two. The OI and the put call ratio. So you could see the put call ratio starting early November jumped from 49 to almost 5,900. So that means the share of the put contract, I mean, from total OI was increasing. That is showing. It is safe to say that is mostly due to hedging the upward move in the market. But when we look at the uh, OI itself, the jump was crazy compared to what we had. So not only the IBIT and all these ETFs have their option and institutions are using that, the crypto native traders were using this uh, option market to be able to hedge the upward, and that is a sign of like how Bitcoin is maturing, because the uptrend is a multi-year uptrend. That is a sign of like more liquidity in the market in general, and that is a positive thing, both in crypto native and also looking at the IBIT. Since a couple of days ago, you could see in that, I mean, the traditional market as well, you could see the increase in the OI. I was looking at different interpretation of what's happening, and IBIT has the highest open interest right now. Is 1.1 million contract. It's not in dollar, it's in contract, and I don't see what is the notional value in dollar, but it is really huge number.
So
1
each
million.
contract is 100 IBIT, and one IBIT is now about $50. So each one of those contracts is $5,000.
Wow.
Yep.
The only thing I noticed that was interesting, the highest open interest among all different major open interests is the put and call for 17th of January. It's a little bit after the Trump's getting to office, and it's around 54, which is I think equivalent to 96, 97. And as you can see, the open interest in both strike price, I mean, both call and put for the same date, expiry date is pretty close. That is showing they're trying to monetize the volatility. When you see a balance between the open interest at the specific strike price and in the same expiry date, there's a chance they're doing a straddle and they're trying to bet on both sides. So you could see this is some move by institution. It's not a move usually by, I mean, ordinary traders. You could see they're trying. You could see the footprint of the institution in the market already in this less than a week. They're using this because they have been doing this in traditional market like years and years, and now they're doing it in Bitcoin. As you can see, these are the institution who are trading this beast now. And when you look at the derivatives itself, I think I have yes, I think yes, in derivatives I was looking at different expiry dates for late December 27th. That was one of the highest expiry date with the highest open interest. You could see when you look at the density of the out of money calls, you could see there is a big density around 100 and 110. That means if we get close to 100, 110, the chance of having a gamma squeeze in the market is really high. What does that mean? It means, correct me, Sina, if I'm wrong, that means if we move towards 100 and above 100, that move is going to be quick again. If this is the expectation, that is not a hard written future. We're just saying the expectation of the derivative trader, which is they have a good weight in option market still. They are expecting if we break above 100, 100 and close to 110, the gamma squeeze is going to happen. The market maker have to cover their the calls they sold. They have to start to buy in the spot market. The
Yeah,
same time
so these market makers like follow formulas to determine how much backing they need. It's kind of like the fractional banking because they don't back all the calls all the time. They just use a probability model to say, okay, reasonably, we don't need all of it. Maybe we will only back 80% of it. But if the price gets to a place where there are a lot of call options, then they have to quickly buy a ton of Bitcoin just as backup if those call options actually are exercised.
Yeah, and I try to look at the puts, assuming some of these puts definitely are a part of a bigger strategy like a straddle. So I'm not gonna say all these puts are for hedging, but when you look at the calls at the same price level, or I mean using different filtering system in the option chain scanners, I was seeing there was a lot of talk about, okay, some of it is definitely part of a bigger strategy, but you could see around 80,000 and below 9,000, these two like strike prices are probably the resistance from their uh, derivative traders perspective. I have to repeat myself. I'm not saying this is a definitive or 100% certainty here. We're just talking about what is the expectation of the derivative option traders. So the bottom line is, I want to say these tools are allowing more sophisticated traders now, thanks to IBIT and other tickers. Traditional experienced traders are using these metrics, sorry, these vehicles to enter the Bitcoin market. And long term, it is really positive. And get back to what I showed about long term holder MVRV, I expect we will see less than 4 year cycles more and more often. And this is the beauty of Bitcoin. It is I call it a live creature now. It's reacting to the surrounding events and big
Essentially,
changes.
a lot of speculation will happen in the paper markets moving
Yeah.
forward, and it doesn't have to find its way to the spot. So spot is going to be a lot more tame. I really feel bad
Definitely.
for that guy that holds the put option on your chart at 40 at the strike of 45. If you show that with the mouse,
Yes.
45,000. This guy is protecting their investment against price falling to 45K by December 27. So he has 27 days to profit to profit from this. But that option is most likely going to expire worthless, and whoever sold it is a genius. So congrats to them.
I mean, if they bought it a long time ago, it's just understandable. Maybe there was something crazy going on. But I mean, if they bought it recently, it's like a lottery ticket. I mean, if it happens, the buyer of this put is going to make a lot of money. I call it cheap lottery tickets if it's just being, because I think the premium will be really low, right?
Yeah,
Yeah.
exactly. Yeah,
Yeah,
it would
premium.
be very low. Yeah, but the time to sell this is when the price is correcting. Like when the price is
Yes.
sharply coming down, people get panic and they buy a lot of insurance at a high price. Right now, no one is worried about 45. So probably this thing is actually worthless already. So, uh, but yeah.
Yeah. So yeah, that was it. Like I really like the implication that people are talking about. Some of them are too naive. Like even for me, that I don't know nothing about option, it seems like people are saying, "Oh, too much call. We're gonna go to 110," which doesn't make sense. But I mean, I agree with the people are saying this is another step towards of being a mature asset, and this is a unique asset because there are lots of debate there. But you cannot say it's commodity or currency. I mean, 100%. It's something in between, and it's just not a function of the US market. It could be a function of a country who is entering a war and lots of capital trying to find a way out. They might start to buy Bitcoin at 2 a.m. Saturday morning. So it is the beauty of this market. And they were saying, like, okay, that's why we have a volatility, a smile, I think, in the option market. And that means that they expect the correction and price move up with the same, not almost exactly the same probability, but more probable than traditional market. And this is just beautiful. And I think everyone, when it gets into details, are gonna be stuck there for days and days, or maybe months, to learn what's happening.
Yeah, it's very important for everyone to understand options. These are going to just add a lot of opportunities for speculation or for like more smarter protection. Um, and sometimes, frankly, if you are in a FOMO driven market, maybe you're scared of putting real money. You can buy options to just make sure you will benefit from the upside without a lot of money down. And you cap, essentially options allow you to cap your losses or do all sorts of complex things. For instance, you can do bets like I only think the price will go up from 100K to 300K next year, and then anything above it I don't think so. And then you can have a bet that exactly focuses on this range. And if the price reaches that range, you're in profit. And just because you give up on the super high profits, you can earn some more premium as well. If you feel like you're at the top of a cycle, you can sell call options for generating cash flow on your holdings. So that way you don't have to sell anymore. Also, you can buy puts to insure it against downside moves. So if you have a put option against a position, then you're guaranteed to not have a lower price. Whatever happens to the market, your price is set. So these things are really, really helpful, and more sophisticated people will use them. And the beautiful thing about options is it's complex. Because it's complex, you don't get a lot of degen behavior. I mean, you do get a lot of degen behavior, but there's an opportunity to kind of study, learn, and become an expert, and then benefit from it. Because it's very hard for people to like profitably trade these things. So, but it's complex math, and the people who worked on it got a bunch of Nobel prizes and so on. It's quite a bit of math actually, and so if you have appetite for it, you can learn it and somehow make math exciting and make money for you. So I think we might actually dive deeper into options moving forward, because they just got a lot more exciting when they are trading on Bitcoin ETFs. There is also MicroStrategy options, which are 3-4 times more volatile than Bitcoin. Those ones are crazy. The price of MicroStrategy could double in a day. So guessing where the price will go is very difficult on those. So whatever you do, please don't bet against MicroStrategy's price. It can triple in a week. So you could lose a lot of money if you're on the wrong side of that trade. Anyways, so thanks a lot. I think we are just a little bit past 1 hour, pretty much what we expected. Is there any final points you want to mention?
No, Sina, I really like our weekly sessions. I know it's a little bit boring sometimes because there's too much terms and keyboards going around, but I started to learn about all these things listening to another session like this one. I think it was Czech talking to someone back to 2020. So I hope these keyboards and all these complex concepts give an incentive to people to go read and more about Bitcoin. We're not trying to be like fortune teller and say, okay, Bitcoins go up and down, even though sometimes like now I might ask you, what do you think next is going to happen? But it's just some speculation. The main purpose here is just talk about what is important in terms of like metrics, tools, what's happening, and also give some keyboard for you guys to go study further. And I really like it, and hopefully soon we got to talk about option and the confluence between option and on-chain. That is like, oh my God, it's just another level of complexity in the same time. Exciting stuff. Yeah.
Okay. Again, we are very thankful for you, for having you. Guys, Z is the one who writes institutional reports for Glassnode. So we are getting all that institutional knowledge for free here. Thanks a lot for coming on, and we look forward to our next chat next week.
Lovely. See you, Sina.
Thank you. Bye-bye.